Okay, so you want to own a hotel. A famous name over the door, hundreds of rooms, guests paying every night. Here's the first thing to understand, and it dismantles the entire picture. The company whose name is on that building almost certainly does not own it, and it very likely does not run it either. There are three separate companies standing in that hotel. There's the brand, which licenses you its name. There's an operator, which manages the place for a fee. And then there's you, who put up several $100 million and who is the only one of the three with anything at risk. They both get paid off the top. You get paid last, if at all. So let's meet all three, because understanding who is standing in that lobby and what each of them is taking out of it is the entire business. Start with you, the owner. You are the one who found the site, which in any city worth having a hotel in is expensive. You are the one who built the building, which is one of the most capital-intensive structures there is, because a hotel is not simply a box with beds in it. It is hundreds of individual rooms, each requiring plumbing, power, climate control, and soundproofing from its neighbors. It is a commercial kitchen, or several. It is a laundry operation capable of processing an industrial volume of linen every single day. It is lifts, and a lobby, and a ballroom, and back-of-house corridors, and a loading dock, and a plant room in the basement, running all of it. You paid for every square meter of that. And because nobody pays for a hotel in cash, you borrowed a very large share of it, which means there is now a lender with a lien on the building and a payment schedule that does not care how your Tuesday went. So the owner carries the capital, carries the debt, and carries the risk. Hold that, because it's the punchline. Now the second company, the brand. The brand is the name above the door. And here is the thing that surprises almost everybody. In the modern industry, the big hotel brands have, to a remarkable degree, got out of the business of owning hotels. They discovered something rather beautiful, which is that owning buildings is capital-intensive, risky, and cyclical, whereas licensing a name is none of those things. So what they sell you is not a building. It's a package. You get the name, which people trust. You get the reservation system, the global machine that puts your rooms in front of travelers. You get the operating standards, the training, the procurement, and crucially, you get the loyalty program, and we're going to come back to that because it is far more important than it looks. And what do they charge? A fee, calculated as a percentage of your revenue, sometimes several fees layered. A franchise or license fee on your room revenue, and a marketing contribution on top. Notice the shape of that. It comes off your revenue, not your profit. Which means in a year where your costs ran high and you personally made nothing, the brand still gets paid in full, on time, exactly as agreed. Now the third company, the operator. Because in many cases, the owner does not run the hotel either. Running a hotel is a specialist operation, and a great many owners are property investors or funds or families who own the asset but have no interest in staffing a kitchen or managing housekeeping rotas. So they hire a management company. And in a great many hotels, the people in the uniforms, the front desk, the housekeepers, the chefs, are employed not by the owner and not by the brand, but by this third company. And how does the operator get paid? Typically, a base management fee, which is a percentage of your total revenue, plus an incentive fee, which is a share of the profit above some agreed level. So now count what is coming off the top of your hotel before you see a single dollar. There is a license fee to the brand on revenue. There is a marketing levy to the brand on revenue. There is a base fee to the operator on revenue. And there is a lender taking interest on schedule regardless. Every one of those parties gets paid whether the hotel makes money or not. And you, the person who bought the land, built the building, and signed the debt, are the residual claimant. You get whatever is left after everybody else has been made whole. Which means the honest structure of the modern hotel industry is this. The brand has all of the name and none of the buildings. The operator has all of the staff and none of the risk. And the owner has all of the risk and, on a bad year, none of the money. Read that again, because it explains almost everything about how this industry behaves. And it produces a conflict that runs underneath the entire arrangement, which is worth understanding because it is where most of the arguments in this business actually happen. Think about what the operator is optimizing for. Their base fee is a percentage of revenue. So the operator has a genuine structural incentive to maximize revenue, which is not the same thing as maximizing profit. Now imagine a proposal. Spend heavily on a refurbishment. Hire more staff to raise the service level. Push the marketing budget. All of these things will lift revenue and therefore lift the operator's fee. But who pays for them? The owner does. Every dollar of that spend comes out of the owner's pocket, and it may or may not earn its money back. So you have a manager who is paid on the top line, spending the money of a partner who is paid on the bottom line. And those two people, sitting across a table looking at exactly the same hotel, will genuinely and honestly disagree about what should be done with it, because they are being paid for different things. That is not a scandal either. It is simply what happens when you separate the person who runs a business from the person who owns it, and every hotel management agreement in the world is, at heart, an enormously detailed attempt to manage that single problem. Now, at this point, you might reasonably ask why anyone accepts that deal. And it's a fair question, and the answer is genuinely good, so let's be honest about it. Try to imagine the alternative. You build a beautiful hotel and you call it your own name. And now a traveler in another country, planning a trip, has never heard of you, has no reason to trust you, and cannot find you. The brand solves that. And the way it solves it is more powerful than most people realize. Because the brand's real weapon is not the sign. It's the loyalty program. Think about what a loyalty member actually is. It is a person who, when they need a room in a city, does not go and compare every hotel in it. They go directly to the app of the chain whose points they are collecting, and they book because their status matters to them and they want the night to count. They are not shopping. They have effectively pre-committed, and every night they stay somewhere else feels like a small loss to them. That is an extraordinarily valuable customer, and the brand has millions of them. When you affiliate with a brand, you are buying access to that river of pre-committed travelers. And the operator solves a different problem, which is that running a hotel well is genuinely hard, and the difference between a well-run and badly run property is enormous. A specialist operator brings systems, trained people, and a management bench you could not build alone. So the fees are real, and so is what they buy. This is not a swindle. It's a trade. But it's a trade in which you supply the money and the risk, and it's worth being extremely clear-eyed about that before you sign. All right, let's look at how a hotel actually earns, because the core engine is one of the most beautiful and most dangerous machines in real estate. The industry measures itself with two numbers: occupancy, which is what share of your rooms are sold, and rate, which is what you sell them for. Multiply them together and you get revenue per available room, which is the number everybody in the industry lives and dies by. Now here's the crucial insight, and everything downstream depends on it. What does it actually cost you to sell one more room tonight? The building is already built. The debt is already owed. The staff are already rostered. The lobby is lit, the lifts are running, the plant room is humming. That room exists, whether anybody sleeps in it or not. So, the marginal cost of filling it is small. Some linen, some cleaning, some electricity, a little amenity, perhaps a fraction of a housekeeper's time. Which means once you have sold enough rooms to cover your enormous fixed costs, every additional room night is close to pure profit. That is ferocious operating leverage. And it is why a hotel running at high occupancy in a strong market is an astonishing money machine. The revenue climbs, and the costs barely move, and the gap between them is yours. Hold that thought very carefully, because it is a loaded weapon, and it is currently pointed away from you. But first, one more property of this business that makes it unlike almost anything else, and it follows directly from the arithmetic we just did. A hotel room is the most perishable product in commerce. Think about what that means. A shop with unsold stock can sell it tomorrow. A vineyard with unsold wine can sell it next year, and it may even be worth more. A storage facility with an empty unit can rent it next month. An unsold hotel room tonight is gone, permanently. There is no inventory. You cannot store tonight and sell it on Friday. At midnight, every room you failed to sell simply ceases to exist as a product, and its entire value is destroyed, forever. and it happens again tomorrow, which produces a very particular kind of desperation, and it explains something you have almost certainly noticed as a traveler. Why does the price of a hotel room move so violently? Why can the same room cost 3 times as much on one night as another, or drop by half if you book it at 6 in the evening? Because the owner is not really pricing a room. They are pricing a thing that is about to expire. And a product that will be worth precisely nothing in 6 hours is a product you will sell for almost anything rather than nothing at all. That is why hotels have some of the most sophisticated revenue management systems in any industry, algorithms constantly adjusting the price of every room type for every night, based on how the bookings are filling, how far out you are, what the competition is charging, and what the software believes about the future. The room does not have a price. It has a price right now, and that price is a live calculation about how likely it is that somebody better will come along before the clock runs out. Now, before we get to the trapdoor, we have to talk about something standing between you and your customer, and it is one of the great, quiet transfers of wealth in modern business. The booking sites. Here is your position. You have spent several $100 million building a hotel, and a traveler in another country wants a room. And the way that traveler finds a room, overwhelmingly, is by going to an online travel agency, typing in a city, and looking at a list. You need to be on that list. And to be on it, you pay a commission on every single booking it sends you, and that commission is a meaningful slice of the room rate. Think about what has happened there. You built the building. You employed the staff. You carry the debt. And a company that owns no property, cleans no rooms, and has never made a bed takes a cut of your revenue every night for the service of being the place where people look. And you cannot walk away because that is where the customers are. If you delist yourself, you don't punish the booking site. You simply become invisible. You built the hotel. Somebody else owns the front door. And now, suddenly, you can see exactly why that loyalty program mattered so much. A guest who books directly with the brand's app is a guest whose booking cost you no commission. Every direct booking is a toll you didn't pay. So the entire industry now fights a permanent, expensive war to drag customers away from the booking sites and into their own apps, offering member rates and points and perks, all of which cost money, but cost less money than the commission would have. That war between the hotels and the platforms that sell them is one of the defining economic struggles of this industry, and it is invisible to almost every guest. So, where does the money actually come from? Let's stack the layers. The first is rooms, the core. High margin, once you're past break even, and utterly exposed to demand. The second is food and beverage, the restaurant, the bar, room service. And here's an honest observation the industry makes about itself. Hotel restaurants, as standalone businesses, are frequently mediocre performers. They exist partly because the brand standard requires one, and partly because a hotel without a restaurant is a hotel guests will complain about. The bar, though, is usually a genuinely good business because it sells a high-margin product to people who are tired, away from home, and not going anywhere. The third layer is where the real reliability lives, and it is the least glamorous part of the entire property. Groups, conferences, banquets, weddings. Look at what a conference booking actually is compared to a leisure guest. A company books 200 rooms for 3 nights, months in advance, at a contracted rate. They also book the meeting rooms. They also buy the catering, the coffee breaks, the banquet dinner, and the bar tab. They pay a deposit. They do not cancel because it rained. That is not a guest. That is a contract. And it fills your building on a Tuesday and a Wednesday, which are precisely the nights a leisure hotel struggles to sell. Which is why so many large hotels are built with ballrooms and meeting floors that seem wildly oversized for the number of bedrooms. Those spaces are not an amenity. They are the machine that fills the bedrooms midweek, and the most valuable guest a hotel can have is very often not a person at all. It is a signed group contract. And then the fourth category, the ancillaries, which exist for one reason. The guest is already on the property and has limited alternatives. Parking, which is frequently charged and frequently expensive. The spa, the minibar, the laundry. The resort fee, that mandatory daily charge, which has become so widespread and so resented. Every one of those is money extracted from somebody who is standing inside your building and cannot easily be somewhere else. So stack it up: a high leverage room business, a mediocre restaurant, an excellent bar, a genuinely valuable group and conference operation, and a set of charges levied on the captive. In a good year, that is a magnificent machine. And now, the trapdoor. And it is, I think, the most brutal in this entire series. And it comes from the very thing that made the hotel so beautiful on the way up. Here it is. Every single lease in that building expires at 11 in the morning. Sit with that. Think about every other property asset. An office tower has tenants on 10-year leases, contractually obliged to pay you whether their business is thriving or collapsing. A shopping mall has leases running for years. A warehouse, a factory, a ground lease, all of them have one thing in common. When the economy turns, the tenant is still legally required to pay you, and that contract is a floor beneath your income. A hotel has no floor. You re-let every single room, every single night, to a stranger who has made no commitment to you whatsoever. Your entire tenancy turns over daily, which means your revenue is not protected by anything. Not a contract, not a term, not a clause. It is exposed, completely and immediately, to whether people happen to feel like traveling this week. And now bring back the leverage, and watch what it does in reverse. We said that once you are past break-even, every extra room night is nearly pure profit, because your costs barely move. But that sentence works in both directions, and the other direction is a massacre. Because if the costs barely move when occupancy rises, then the costs also barely move when occupancy falls. The debt payment does not fall. The brand fee is a percentage, so it shrinks a little, but the brand still gets paid on whatever you do sell. The management fee, likewise. The building still needs heating, lighting, security, insurance, and maintenance. You can cut some staff, and hotels do, brutally and fast, but you cannot cut the building. So a hotel at 40% occupancy is not earning 40% of the money. It is earning far less than that, against a cost base that has barely shifted, which means it is not merely unprofitable. It is hemorrhaging every single night, and the losses are enormous relative to the size of the business. That is why hotels are the most violently cyclical major property asset there is. They are the first thing to feel a recession, because business travel is the easiest budget line for any company to cut, and leisure travel is the easiest thing for any family to postpone. And when it comes, there is no lease anywhere in the building to slow the fall. Read that again. The office tower and the hotel are in the same recession. The office landlord is being paid because he has contracts. The hotel owner is not, because his contracts expired this morning at 11. So let's answer the question we opened with. What do you actually own when you own a hotel? You own the only major property asset with no lease protecting it. You have financed it with the most debt. You are paying two other companies off the top, one of which owns nothing and one of which employs the staff. There is a booking platform standing at your front door taking a toll on your guests. And you, the person who paid for all of it, are last in the queue for every dollar the building earns. That is the honest structure. And here is the strange part. People fight to buy these things constantly at enormous prices, because when it works, it really works. The leverage that destroys a hotel in a downturn is the same leverage that makes it extraordinary in a boom. A well-located, well-run hotel in a strong market, at high occupancy and rising rates, throws off cash at a rate that a boring old office building with its safe 10-year leases could never approach. You are being paid, in other words, to accept the risk that nobody else in that building is willing to take. That's the deal. It always was. So, should you buy one? Here's the honest split. The optimistic version goes like this. You own a strong property in a city people genuinely need to be in, with a diversified demand base, so you are not dependent on any single kind of traveler. You have a serious group and conference operation, so your midweek is contracted rather than hoped for. You have negotiated your brand and management agreements hard, because those fees compound over decades. You drive direct bookings relentlessly, because every one is a commission you keep. You do not overborrow, so that a bad year is survivable rather than fatal. And in the good years, and there are many, the operating leverage does what it does, and the money simply pours through. The harder version looks like this. You bought at the top with a great deal of debt because the numbers looked wonderful and the market was full. Then the cycle turned, as it always does. Business travel evaporated first, then leisure. Your occupancy fell through the floor, and your costs did not follow it down. The brand fee kept coming. The management fee kept coming. The lender kept calling. And you discovered, standing in a beautiful empty lobby, that not one person in that entire building owed you a single night's rent. And notice what decides between those two futures. It is not the quality of the hotel. Wonderful hotels go bankrupt in recessions, and mediocre ones survive them, and the difference is almost always the debt and the timing. Because in the end, a hotel doesn't rent you a room. It rents itself out entirely, every night, to strangers who owe it nothing. And every morning at 11, it is empty again and has to be sold all over again, forever.